And we have time to have a quick look at the US markets. We'll do that with our guest. So we got that very weak February jobs report and oil prices continuing to soar. Not a pleasant environment right now. We're hearing the stagflation word. Adam Turnquist joins us now, Chief Technical Strategist at LPL Financial. Thanks very much indeed for joining us.
Yeah, thanks for having me.
I know this job number could have been a bit of a blip caused by strikes in the healthcare sector and weather, but certainly not a pretty picture. Much higher energy prices today and a weak job market.
Not a good combination, Andrew. Thanks for having me on again. The labor market throwing a wrench into any type of recovery today. Of course, negative payroll is never a good sign. The unemployment rate ticking higher. But as you mentioned, there's some caveats to that with a major healthcare strike and some weather here in the U.S. that likely impacted it. But nonetheless, it does bring stagflation back into the conversation, and it does complicate the Fed's job in terms of what they're going to do for future rate hikes, or future rate cuts, I should say. We heard from the Fed in January. They talked about the idea of the labor market stabilizing. I think that language could change as we go into the March meeting for the Fed on the 18th. So I'll look for some commentary around that from the Fed. But really, oil is in the driver's seat right now for equity markets. You can see that oil price is surging and the S&P 500 trading lower. Of course, that is further complicating the Fed's challenge of bringing inflation down, with WTI crude oil, or West Texas Intermediate, near $90 a barrel here this afternoon.
I know this is an impossible question to answer, but in recent decades, violence in the Middle East has temporarily pushed up oil prices, but then they drop again. Is there any reason to think it'll be different this time?
I'm going to go with history on that, and the market has done a pretty good job of moving past these major geopolitical events. We've done analysis going back to Pearl Harbor and looking how the market performs around these major events. The average drawdown, about 5%. It typically takes about 38 trading days to recover from that drawdown. And it's really the other macro forces that drive longer term performance. Things like earnings, of course, economic growth, inflation. And we think that story still holds up, although there is obviously some added risk here. When we look at oil, for example, on WTI, I think if we can close below the 2024 highs by today, that would be a win given all that's going on in the market. And if the S&P can get back into its prior range above 67.75, I think that would be a good sign. At least maybe we're due for a little bit more stability here going into next week.
Maybe we could put up that oil price again. So from a technical viewpoint, we have gone through the April 24 highs, obviously, which were 87.60 or so. And we've now got through we're nearing the 2023 highs of about $95. What if we break through 95?
Well, if we break through 95, the narrative is certainly changing. And I think that's the market telling us, look for a more prolonged war, much longer than at least a few weeks. I think that also suggests the Strait of Hormuz, where 20% of the global oil market transits through, is likely going to be closed for a period of months, maybe not weeks. And that's just going to add to the inflation risk. It's going to push up gas prices, weigh on the consumer, and really goes back to that stagflationary story that we talked about with the employment report this morning.
What kind of stocks do you favor right now? I mean, are you turning to the good old defensives, discount retailers, food, utilities?
We like the aerospace and defense area. We've liked it for a while. We own that in one of the portfolios that I help manage. When you look at the trend, obviously up and to the right, so we always like to see that. It's up, some of the select industries in that area up over 60% over the last year. So it's not a new phenomenon here that the aerospace and defense areas are working. You look at the current geopolitical environment, it's been elevated in terms of risk for the last few years. That's really pushed spending, whether it's U.S. defense budgets increasing or globally. When you look at NATO's commitment to spending 5% of GDP on defense by 2035, we think those are secular themes and tailwinds for this space. And of course, technically, we like it. It's breaking out to new highs. It's had a little bit of volatility here as it gets wrapped up in this risk-off trade. But it's also been a consistent outperformer, which we're always looking for, that relative strength in the market and that trend has been also up and to the right.
So, sorry, you're talking defense and aerospace stocks there. I mean, not necessarily these names, but things like Lockheed Martin or Raytheon or even Boeing.
They're all in that category. So
Right.
all of those names are in most of the sub-industry groups that we like within the aerospace and defense.
It's really amazing. I was reading an account of one Canadian couple in the Middle East, and from their hotel balcony, they were apparently watching projectiles being shot down by the local air defense system.
Right, and when you look at the spending on aerospace and defense, it's just going. I would call it almost parabolic because of these events that are taking place. They're becoming more frequent. They're prolonged. Look at Russia and Ukraine. That war has been ongoing for several years now with really no signs of abating, unfortunately. And the geopolitical environment right now just remains elevated in terms of risk. And that, again, is fueling spending. We had President Trump talking about 2027 spending for defense at $1.5 trillion. That's nearly 50% more than the 2026 budget, around $840 billion. So spending's going up, and the technology going into the defense systems is really interesting as well. It's almost an AI trade in itself when you think about what's being baked into the components and the munitions that are used to strike down enemy missiles or whatever's coming in.
I read a book about the Falklands War in the early 80s. A while ago. I mean, they had missiles, guided missiles back then to shoot at the Argentinian planes, but they were just so primitive compared to what they have now. Consumers, even without this rise in oil prices, you reckon there are signs that consumers have been cutting back on spending?
Yeah, when you look at retail sales data today, we'll call it a little bit disappointing, better than expectations, but down on the month. This also had some weather-related impact. You had what I like to look at, restaurants and bars, people going out, are they spending money? That's been down now for 2 straight months. Not a great look for the consumer. Offsetting that, we've had a big increase in online sales. So people are spending more online. Also, building materials was up this month. So a bright spot in a relatively, we'll call it underwhelming retail sales report this morning.
Thank you very much. I really appreciate it, Adam.
Thanks for having me.
Adam Turnquist, Chief Technical Strategist at LPL Financial.